Hi, I'm Steve. I'm going to share my thoughts on how you can achieve a better financial future. Please remember, I don't know anything about your situation, so think for yourself and use what fits. Welcome back to our discussion of practical finance topics. Using borrowed money to invest in the stock market is called buying on margin or using leverage. In some ways, it's similar to buying a house by borrowing a large portion of its value. In both cases, using debt magnifies the financial outcome, for good or bad. As an example, imagine you buy a house for $300,000 with $15,000 in cash and borrow the rest. You have $15,000 of equity or ownership. If the value of the house rises by 10% to $330,000, your equity triples to $45,000. The leverage math is asset divided by equity, which is the leverage ratio, times price change equals equity change. So in this case, it simplifies to 20 times 0.1 equals 2, and 2 times $15,000 equals $30,000, i.e. the amount your equity grew. Unfortunately, the same math works on the downside. A 10% drop in the house price would cause you to be underwater by $15,000, i.e. the loan amount is $15,000 higher than the value of the house. A long-term bet on a house can be a great way to build wealth. Over the long haul, house prices generally rise, making leverage work for you. And there are some very attractive tax benefits associated with home ownership. Two things make using leverage to invest in stocks much more risky than real estate. The first is that the stock market is much more volatile than the housing market. The second is that while you can be underwater and still live in your house, with stocks, you'll receive a margin call or demand for more cash if stocks drop. If you don't have the cash, you'll be forced to sell, often at the bottom of the market. Annuities are a pretty big topic, and we're just going to scratch the surface here. The basic premise is a combination of a long-term investment and insurance against outliving your money. While the concept is appealing, the actual products offered are often very complex and loaded with fees. There's also the risk that the company backing the annuity goes out of business before you leave the planet. So, be very, very careful here. There is one annuity, though, that I like a lot, and you've heard of it: Social Security. For all the worrisome headlines, I believe the program will be around for a long time. Yes, some modest adjustments will need to be made, but no politician will want to be part of Social Security disappearing. As a supplement to other savings and investments, it's a terrific program. As a side note, pensions have a similar structure. The biggest question for these is whether the guarantor will have sufficient funds when the time comes. Many are seriously underfunded, especially, but not entirely, in the public sector. Unlike the U.S. government, the state of Illinois, for example, does not have access to the money printing press. Well, that's it for this session. Thanks for watching, and I'll see you next time.